Bitcoin was born in response to the failings of traditional finance. Satoshi embedded a message in the Genesis block referencing a bank bailout, a clear act of protest. The Cypherpunk movement believed in privacy, sovereignty, and peer-to-peer value transfer without middlemen. The original vision? Decentralized money that no government, no bank, and no institution could control. Early Bitcoiners ran their own nodes, mined blocks from their laptops, and rejected the traditional financial system outright. Bitcoin wasn't meant to be embraced by Wall Street. It was meant to replace Wall Street. We've got BlackRock, Fidelity, ARK, and Grayscale holding billions in BTC. ETFs have made Bitcoin accessible to millions of traditional investors overnight. On the surface, this is bullish. Institutional capital brings liquidity, credibility, and price appreciation. But here's the dilemma. Bitcoin was designed to disintermediate exactly these types of entities.
I think that's one area where the incentive mechanism of Bitcoin has surprised to the upside. I think if you'd asked people this question, 5 years ago, they would worry that there would be dilution of the kind of permissionlessness and bearer nature of the asset.
When BlackRock holds your Bitcoin, you don't hold Bitcoin. You hold an IOU. That's not self-custody. That's not sovereignty. This growing institutional layer is convenient. But is it Bitcoin? Or is it fiat in Bitcoin's clothes? Here's the philosophical debate. Is Bitcoin changing the system, or is the system changing Bitcoin? The risk is centralization creep. If most people access BTC through ETFs or custodians, power concentrates again. We recreate the same trusted third parties Satoshi warned us about. KYC, blacklists, surveillance, all these creep in through the back door of regulation and compliance. Bitcoin's opt-in freedom becomes a permissioned walled garden. But here's the nuance. Bitcoin itself hasn't changed. The protocol is still decentralized. It still produces blocks every 10 minutes. The supply cap is still 21 million. Anyone can still run a node. It's not Bitcoin that's at risk. It's how people choose to interact with it.
Presidents of countries, politicians who are clearly personally invested in Bitcoin. And, even today, the president of the country and his son who was just on stage. So I think, for example, with Blockstream's asset management, we recruited Sean Bill, who I think Dan knows, and he got the first Bitcoin into a public pension fund in the US, but he was personally investing in Bitcoin for years before he was able to do that.
The institutional layer is growing, yes, but so is the grassroots. Tools like Lightning Network, Fedimint, Nostr, and cold storage hardware wallets are enabling individuals to stay sovereign. Projects like Bitcoin Beach, El Salvador's legal tender experiment, and community-run mining pools show that the cypherpunk ethos is alive, even if it's quieter than Wall Street headlines. There's a cultural tug-of-war happening. One side sees Bitcoin as digital gold for portfolios. The other sees it as digital freedom for the people. And the beautiful truth is, both can coexist for now. Bitcoin is evolving into a multi-layered ecosystem. On one layer, institutions can have their ETFs and custody solutions. They bring capital and mainstream attention. On another layer, developers and freedom maximalists can build censorship-resistant tools, run their own nodes, and transact peer-to-peer.
Roles in society get enamored by Bitcoin. So really, it seems to be so far scalable at all the levels it's touched in terms of going to bigger institutions, to institutionally managed money. The other thing I would say is that, for the consumer outlook who's not used to the money management world, that ultimately most money that is managed professionally is on behalf of individuals. So, the pension fund beneficiaries are, maybe a transport authority or teachers or something like that, right? So giving them access to Bitcoin is a positive, ultimately.
The network doesn't discriminate. It's neutral. You can hold your keys or not. You can follow KYC or not. You can use it to store wealth or resist tyranny. That's the power of Bitcoin. It can be both a savings asset for BlackRock and a lifeline for a protester in Nigeria.
Investment in institutional custodian, because the way that traditional finance interfaces to equities even is via an independent custodian. And so that's clearly an interface for Bitcoin as well.
So does institutionalization threaten Bitcoin? Maybe it threatens the way we use it. Maybe it waters down the original message for the masses. But Bitcoin, the protocol, the revolution, isn't going anywhere. The code is still open. The network is still decentralized. The mission is still alive. And as long as people continue to run nodes, self-custody, and build, Bitcoin will always belong to the people. The institutions, they're just temporary guests in a house they didn't build. If you found this thought-provoking, hit like, subscribe, and drop a comment below. Do you think Wall Street is good or bad for Bitcoin? Until next time, stay sovereign, stay sharp, and keep stacking.